Who is required to pay estimated taxes? Have you ever wondered who needs to pay estimated taxes? This is especially important for retirees who may have various income sources. Let's break it down in a straightforward way. Estimated taxes are payments made to the Internal Revenue Service for income that does not have taxes automatically withheld. This situation often arises for individuals who earn income from self-employment, rental properties, interest, dividends, or certain retirement distributions. For retirees, knowing if you need to pay estimated taxes is vital. If you expect to owe $1,000 or more in federal income taxes for the year after subtracting any withholding and refundable credits, you generally need to make estimated tax payments. This rule applies to most individuals, including retirees, whose income is not fully covered by tax withholding. Many retirees have taxes withheld from pensions, Social Security benefits, or required minimum distributions from retirement accounts like individual retirement accounts and 401(k) plans. If the total amount withheld does not cover your tax liability, you may need to make estimated payments. Retirees often receive income from various sources, including individual retirement accounts, 401(k) plans, Social Security, pensions, investments, or rental properties. Not all these sources automatically withhold taxes. For instance, when you take a distribution from a traditional individual retirement account, you can choose to have taxes withheld. If you do not choose this option, or if the withholding is insufficient, you may need to make estimated payments. The Internal Revenue Service requires estimated tax payments if your withholding and refundable credits will cover less than 90% of your current year's tax liability or less than 100% of your prior year's tax liability. If your adjusted gross income was over $150,000, the threshold is 110%. If you owed no federal income tax for the previous full tax year, you are not required to make estimated tax payments. When it comes to retirement income, if you take distributions from a traditional individual retirement account, you can request that taxes be withheld. If you do not do this, or if the withholding is not enough to meet your tax obligation, you should consider making estimated tax payments. Taxes may also be withheld from pensions and Social Security payments. However, if you have other income sources, such as investment dividends or rental income, you may still need to make estimated payments. Remember that estimated tax payments are typically due 4 times a year. Missing a payment or paying too little can lead to penalties. In summary, retirees are required to pay estimated taxes if their total tax withholding from pensions, Social Security, and retirement account distributions does not cover their expected tax liability for the year. Understanding these rules can help retirees manage their tax obligations effectively. If you are unsure whether you need to make estimated tax payments, reviewing your income sources and consulting with a tax professional can help ensure compliance.